Hello and welcome back. As the stock market is actually crashing once more today, you're noticing that a lot of these tech stocks and well-known companies are heading down, and one of which is Apple, which is currently down almost 2.5%. And I wanted to take this opportunity to examine the company and actually create a discounted cash flow model for it. See whether it's actually a good idea to purchase some stock right now or just wait it out a little bit, see what makes more sense. But first things first, we want to analyze the company as a whole, see what it has to offer to us, and understand whether it's a worthwhile purchase. So the first thing that we want to examine is always we want to be taking a look at the outstanding shares. That matters a lot because notice that back in 2013, 14 almost, the company had almost 26 billion shares, and now they have 16 billion shares. This means that they bought back a lot of shares. So if you actually were holding shares over here, your shares are actually worth a lot more because now there are far less stocks in the open market. And so it's like you are holding a larger piece of the pie. And so that's a great thing, buying a company that's actually buying back shares. And with this kind of outstanding shares count, I'm expecting that Apple will keep buying shares back. And so that's a very, very positive thing for owning Apple. Now, there are obviously great products, but there are also great prices to buy these products for. And so if you're about to buy a car, you may be willing to spend $30,000, but you may not be willing to spend $130,000 for a specific one. And this is where investing comes into play. We will need to examine the company and see what kind of price we're willing to pay today that makes sense for our investment to flourish in the next years. So, to start off, let's take a look at the dividend yield because the company does pay a little bit of dividend, which is 0.56%. It's almost negligible here. It is something, but it is still 14%, 14.5% of its income. And so that's good to know how much of its income the company allocates to shareholders. That's not a lot, so I'm fine with this one. That's not a big deal. And typically, anything below 50% is probably fine for a company to pay to investors. Even a little bit more could be okay. But you see that the company is actually increasing dividends pretty much year over year. So, income statement. That matters a lot, and we will see here that the company is actually posting, generally speaking, revenues that are increasing over year, and are increasing like 5 and 15% here, but lately they have been increasing even more. So Apple is making a killing with 33% in 2021 and 28% in the last 12 months, really. And the net income here that you will see for the company is sitting at 100 billion, and it used to be 48 back in 2017. So there is good growth over here as well. What about the balance sheet of the company? Two things, very, very important things. The total liabilities sitting at 310 billion, and then the total equity sitting at 72 billion. So a lot of liabilities compared to equity for the company here. And the cash flow is what we want to examine next. You will see that the company has 64 billion from operations in 2017. In the last 12 months, it is doing 112 billion. So, pretty much doubling its cash from operations. That's another great thing. Company is investing a little bit as well, and mainly investment in market securities. I love it when companies do that, when they buy other equities. I think that's a very, very good, very positive thing. Now, you may want to see what they are buying exactly, but 10 billion is probably not a big deal for Apple, frankly. So, cash from financing here, company is also paying back debt here and repurchasing common stock for the most part, as you see, because I'm assuming they don't have too much debt. However, they do still issue debt, and you may be wondering why are they doing that? That's actually a very good thing. I mean, companies who make money need to issue debt because they can use the money that they make for leverage towards getting more debt. And this is a very, very fine thing to do in the world of investing, and it's actually a very good idea as long as you make enough money to sustain this debt and use it to help the company flourish and do better in the future. It provides the leverage that you need to grow faster, is what proper use of debt is. And the free cash flow, which is basically the bottom line for our cash flow statement here, is is actually sitting at 101 billion dollars from 51 in 2017. That's very good growth as well. It's doubling its free cash flow in about 5 years' time. That's great. What about the multiples of the company? A little bit more inflated than that I would like. I'd love to get them at these levels, frankly. So they are a little bit inflated, calling for a potentially overvalued company for the most part. Enterprise value actually it's not very relevant, but return on equity is amazing, 145%. That's absolutely insane. This means that the company is using equity and debt for, which is part of the equity. It's using it to grow, and it's returning 145% on that equity back to shareholders, which is absolutely insane. This is insane return on equity, absolutely insane. I love that. So that's a very, very good thing. And the solvency here tab, which kind of shows us the relation of debt to equity, is high, and you would want to bring it lower. However, does that really worry me too much? I mean, I would want them to, to manage their debt a little bit better. Here it looks like the debt is getting a little bit out of hand, but they are making insane cash flow. That's the problem. That's the good thing, not the problem. Because you may have noticed that their balance sheet is actually having, where was it? Let me find it here. Total equity of $72 billion over here. But their cash flow here for the last 12 months was 101 billion. And actually their liabilities, their total liabilities, let me find it again, they're sitting at 310 billion. So they can use 3 years of free cash flow to pay back the whole thing. So that's not a lot of debt, really. You are seeing that the company has a lot of debt when you compare it to its equity. But when you compare it to the cash flow, which is the most important thing, it's not much. And so that's not a problem. The debt is definitely not a problem for Apple right now. This is what you should compare, really, and not too much the total debt to equity. In some situations, it can tell you a lot of things, though, especially with smaller companies. So the next thing that we want to be doing is examining the free cash flow in relation to the price of the stock, which is 156 as I'm making this video. And so now I'm gonna use my trusty spreadsheet here that I have created. And what I'm doing here is I'm pasting the values of free cash flow for year 1 to year 5. That's 2017 to 2021, really. It's the free cash flows that we examined here. And I can actually show them to you. They are these values, free cash flow. Just paste it over here per year. And you will notice that after I'm pasting these values, I'm getting that the 5-year average free cash flow growth of the company has been about 17%. Now, I'm going to project it for 10 years from now. And so I want to be using a lower free cash flow growth because it's not going to be 17% a year for the next 10 years. I think I'm going to go for 10%, which again may be a little bit of a stretch. But I think for a company like Apple, they can achieve that. I wouldn't be surprised, especially with hearing about a car coming to their bottom line. Like they are probably going to be entering the car business as well. So maybe they can get some extra from this one. We'll see. But 10% may be again a little bit too much to ask for. But I'm gonna go with this one. And I want to be making, let's say, 13% from the company a year annually on my investment. And the perpetual growth rate that I like to use is like 1% for the company in perpetuity. And I have already filled the outstanding shares in million here. I have pre-populated this one. And you will see that we're coming up with $86 per share to buy today, which is almost 50% actually than the current stock price. Now this points to a stock that is potentially overvalued right now. So I'd like to get it at a little bit of a cheaper price. Now I can potentially say that, let's say that the company is going to be growing more, so I have more faith in the growing free cash flow of the company. So let's say it's 13%. In that case, we're getting closer. It's like $105, but it's still a lot. So you see that we're talking about a great company here, which is doing amazingly well, but their stock price is still inflated. So I'd like to get it at a better price. And again, it's all about how much I'm paying for value, because we know that the company is amazing value, but I want to be getting it at a cheap price. I don't want to overpay. That's the whole reason why we're doing this, and I'm using this spreadsheet here. That's what I want to help you with, understand what kind of value it makes sense to pay today, because we're talking about today, not 10 years from now, based on what the company is doing today again, and it's projected to be doing in the next like 10 years. That's what we're doing here. And you can play with these values a little bit, but you're probably going to be at around $80 to $100 for the most part. Now remember, the company is growing massively, and they have some great things to show for. Free cash flow is growing amazingly. I absolutely love the return on equity here. It's amazing. And you may feel like it's okay to pay a little bit more for the company, and I'm okay with that. I think that's a fair statement. So you could just use this model and go like, okay, I will project 11% for gains, and just see what works here. So I'm getting a 131. It's still actually below the current stock price, but it's getting closer. So I think with my estimates here, and I like to be a little bit conservative actually, because I want to be making money. So I like to go more conservative than just buying the company because I like the company. Because again, an investment is about the value also that you're paying, not only the company. And so I think I would like to enter the company if it approaches 100 personally, because that gives me enough margin, if not even less than 100. But I think for $100 I would buy. And that gives me adequate margin, I feel, and gives me a much better entry here for my money. Will that happen? I don't know. It may never happen. But in the current climate, anything could happen, I feel. So hopefully you enjoyed the video. If you did like this one, take a look at this one that I made earlier, and it's about Alibaba's earnings. Very, very interesting. So thank you for watching this one, and I'll see you soon. Bye bye.